One of the learning goals in this workshop is for us to understand and apply methods of depreciation. When we look at depreciation, we have to make a note of three things. One is the cost of the asset, then the salvage or the residual value, that's the value that will remain after use, and the useful life of an asset. There are ways of asset losing value. One is the time dimension. It could be due to time, or because the asset is being used, that it is used in production. That's the second dimension. And the third is due to market forces. Depreciation, the word depreciation applies for losing value either due to time or due to use in production, not due to market forces. That is called impairment. But we are not going to look at that. We are going to look at due to time period and due to use in production. So when we talk about due to time period, there are three methods that applies. Straight line depreciation, diminishing value depreciation, then the third is called sum of the digit depreciation. Due to use in production, asset being used in production, value loses because asset is being used, more units are produced, more value the asset loses. So when the asset is acquired, this depreciation or the loss in value of the asset becomes an expense. So I mentioned to you four methods to estimate depreciation. The first one is straight line. We estimate that the asset loses value in equal amounts in each time period over its useful life. Reducing balance method, we estimate the asset loses more value initially and then progressively it decreases over its useful life. Units of production is based on actual number of units produced by the asset. It loses its value based on the units the asset has produced over its capacity to produce a certain number of units. Sum of the digits method loses value in a descending order based on the number of years used, like reducing balance method. Let's look at each one of these now. Straight line method. We have an asset which is 2,200. We estimate the residual value or the salvage value as 200. Useful life of the asset we estimate as 4 years. And the value that we lose is 2,200 minus 200, 2,000. And that's called the depreciable value. So it is that value that will reduce, that will decrease until it reaches the residual value 200. So let's look at the straight line method. So the depreciable value is 2000, and that decreases over 4 years by equal amounts. And when it decreases, ultimately that adds to 2000, and the residual value is 200, and together makes the acquisition cost of the asset. So the depreciation expense is constant. Reducing balance method. We use a formula. We can find out that formula based on using Excel. We take the residual value 1 minus the residual value divided by acquisition cost to the power 1 over useful life of the asset. That gives us the percentage of depreciation, 45%. And we apply that 45% to the beginning value of the asset. So here's the beginning value of the asset. 45% gives us 990, and the end value is 2200 minus 990, 1210. Beginning of second year, that's the value that will be used for depreciation. 45% of that is 545, and after that decrease, the remaining value of the asset is 666. When we apply that technique over the 4 years, asset loses in value more in the initial years and progressively less in the remaining years. Let's look at units of production. Let's assume that the actual number of units produced are as follows for the 4 years, and the total capacity that the asset can produce, the units it can produce, is 1000. So out of this 1000, 200 was produced in the first year, so that means 20% of the capacity was produced, and we apply that to the depreciable value of the asset. Depreciable value of the acquisition cost, depreciable value, just like in straight line method, 400. We apply that to depreciable value in the second year, and that's 300 over 1000, 30%, and we apply 30% to the depreciable value, 600. And depending on the actual number of units produced, these percentages in given years can change. So we can see that depreciation expense is less and more, and it's quite random in different years. There's no set pattern. Let's look at the sum of digits method. Sum of digits method is where you can use a formula. N is for the number of years useful life of the asset, and then within brackets n plus 1 divided by 2, useful life of the asset plus 1 divided by 2. You also can count the number of years and add them together. 1, 2, 3, 4, add them together, and then you get a number, and that's equals to 10. And in sum of digits method, the first year depreciation is the last number, that is 4. So 4 divided by our total number is 10. So that is the proportion of depreciation we apply to the depreciable amount, not the acquisition cost. Depreciable amount is 2000 and the acquisition cost is 2200. So 4 divided by 10 into 2000 is the depreciation expense for the first year. For the second year, similarly, we take the second last digit, 3 divided by 10 into 2000. When we apply that, you see here depreciation basis is 4 divided by 10, 3 divided by 10, 2 divided by 10, 1 divided by 10, and we apply the depreciable value to that. We get 800, 600, 400, 200. So the depreciation is more in the initial years but less in the later years. But this is very similar to diminishing value method. But I want to show you that they are actually not the same. So graphically, if you plot these numbers, depreciation expenses, you can see straight line method. It's parallel over years, across the years. Then reducing balance method, it is reducing but not on a straight line. Units of production and the depreciation expense is quite random. There's no set pattern. Some of the digit methods is decreasing, but it is decreasing linearly on a straight line or on a linear basis. But that's different from the reducing balance method. But once we have found out depreciation, then we can do the entry, journal entry. The typical journal entry for a year is we debit depreciation expense and we credit accumulated depreciation. So every year we keep doing that, and then our accumulated depreciation expense keeps accumulating over the years. A depreciation expense is for each given year, but accumulated depreciation keeps accumulating. Now that we have spoken about the depreciation methods, the 4 methods, at the end of the period, we know that there's a residual value or salvage value of 200. Now we need to dispose that asset because it's been used up. When we dispose it, then we have to remove the asset. To remove the asset, we reverse accumulated depreciation. So it's a credit, we debit it. We remove the asset, it's a debit, we credit it. Here's that. And then if you are selling, let's say the salvage value in our example is 200. So we sell it for 200. And there's no gain or loss. We estimated as we are selling for 200 and we sold for 200, let's say. So there's no gain or loss on the disposal from what we estimated. So that is 0. So when we do the journal entry, we debit accumulated depreciation, credit the cost, machinery cost, and debit the cash we receive. So there's no gain or loss. Our debits and credits are equal. Sometimes, as we keep depreciating the asset, things might change. We said there are 3 things that we need to take into account when we talk about depreciation. Those 3 things that we talked about are this: cost, salvage value, and useful life. So residual value can change, useful life can change, because these are all estimates. So let's say they change. So then we have to revise our depreciation estimate. So let's take an example. In the 3rd year of a machinery, it has a carrying value of 6,400, and it will have a remaining useful life of 4 years, and it's estimating that the residual value of the asset is not 1,000, it's downgraded to 400. So we take the cost of the asset that as it is now, that's 6,400, that's the carrying value of the asset, cost minus accumulated depreciation. See here, that is what we take, carrying value of the asset, and then we take the revised salvage value and the remaining useful life, and that gives us a depreciation expense of 1,500 a year. 1,500 a year. So that is when there's changes in estimates for depreciation. That's how we calculate.